Chapter 22, Corporations, Formation, and Organization. So these are the characteristics of a corporation. The legal entity, it has the rights as persons and citizens. Can't vote, but can donate to campaigns. Creature of state means that it doesn't pop up automatically. You have to file paperwork with the state. It gives the limited liability of shareholders, which is its main big advantage. Unrestricted transferability of corporate shares. You know, like you can't sell your part of a partnership, but you can sell your corporate shares. It has perpetual existence. Centralized management, corporate tax rates, and liability for officers and employees. So, corporate powers, express powers. These are things that the corporation has to do to maintain its rights. It has the right to litigate, right to make contracts, right to borrow, loan, right to make charitable donations, ability to establish rules for managing corporations. Then some of the implied powers is whatever's actions are necessary within the law to execute express powers. So when you form the corporation, you really set up a document like it's the constitution for the corporation about what the corporation can and can't do, and what the board of directors can and can't do. So an ultra vires act is any action taken beyond the scope of the corporation's authority. So it's going beyond the rules for the managing corporation. Public versus private corporation. Public corporations is a corporation created by government to administer law with specific government duties to fulfill. What that means, when they use the Federal Deposit Insurance Company as an example. Okay, FDIC is a corporation. It collects money from banks to ensure the deposits within the bank. So it's self-funded. Congress doesn't have to send it money every year. It's self-funded. So it's a corporation, but it doesn't make a profit. Everything is put into running the organization and making sure that it has necessary amount of money on hand if a bank goes belly up, to make sure that the deposits in the bank are insured. A private corporation, this is what most of them are, it's a corporation created for private purposes to make money. For-profit corporation, the objective is to operate for profit, clearly, and the shareholders who invested are seeking to make a profit, to make a profit from purchasing the stocks the corporation issues. Nonprofit corporation may earn profits, but they do not distribute these profits to shareholders. It doesn't issue stock, nor does it have shareholders. It just reinvents profits into the business. And that's a whole separate area of the law. Probably won't come into play in your businesses that you work for. Domestic, foreign, and alien corporations. Okay, domestic corporation doing business within state of incorporation. Foreign corporation doing business in states other than the state of incorporation. Alien corporation is doing business in a country other than the country of incorporation. Publicly held versus closely held. Okay, stock available to the public. And when you do that, there's a whole lot of new set of rules you have to follow. So that's why sometimes they're closely held corporations. Just few shareholders, the corporation owns a lot of its own shares, and it doesn't sell stock to the public. Subchapter S corporation, named after provisions of the IRS code that provides for it. It's a particular type of closely held corporation. Remember, those were, we said in the last chapter, could be over 100 shareholders. And it combines the advantage of limited liability and single taxation. Because remember, the corporation has to pay taxes on its earnings, and then the shareholders have to pay taxes on what they get from the corporation. Okay, the formation of a corporation. First, you have your promoters who organize the corporate formation. Then they offer, subscribers offer to purchase stock in corporation in the formation process. And then the state is selected for its incorporation. And that can make a big difference with state incorporating, especially if you're going to be doing business nationwide. How much flexibility does the state grant to corporate management? You know, these are corporations are set up in a single state, and those states are going to have rules for their corporations. So these are the things you need to look into in deciding which state to incorporate in. How much flexibility does the state grant to the corporate management? What rights do state statutes give to the shareholders? What restrictions does the state place on the distribution of dividends? And does the state offer any kind of protection against takeovers? Delaware offers a lot of these features, which is why a lot of national corporations are actually incorporated in Delaware. Okay, the process. First, you come up with a name, and then there's articles of incorporation, so the constitution of the corporation. Those are drafted, and then they're filed with the state. Then the first organizational meeting is held. Now, say you did something improperly. If it was just like you didn't quite get all the paperwork right, then it's going to say it's a de jure corporation and let it operate while you fix the paperwork. De facto corporation means that the corporation has not met the requirements of state incorporation statutes, but courts will recognize it as a corporation for most purposes to avoid unfairness to third parties who reasonably believed it was properly incorporated. They held themselves as a corporation. They hadn't done all the paperwork, and someone else maybe lent them money based on that. So they're going to treat it as a corporation. Corporation by estoppel. Corporation prevented by court from denying its corporate status. And piercing the corporate veil. Shareholders can be found personally liable when they've used the corporation to engage in illegal or wrongful acts. And piercing the corporate veil is something that comes up a lot in court cases, especially when a company goes belly up. And then the creditors and the vendors all want money the corporation doesn't have. So in those times, they might try to pierce the corporate veil, and then they can go after the pockets of the shareholder. And that's, there are a lot of protections to prevent that, but there are a lot of things you can do that will make it easier to have your corporate veil pierced. Wrongful acts, illegal acts. A lot of times it's that one of the directors or major shareholders was using it more as a bank, an ATM machine. They go in and just take money from the till. So that would be pierced, and that person could be going after personally. Likely to pierce corporate veil when the corporation lacked adequate capital. Corporation did not follow statutory mandates regarding the corporate business. Shareholders' personal interests and corporate interests are commingled. That's what I mean by like going in, get money from the till, hiring yourself. And it's a shareholders attempt to commit fraud through the corporation. So that's another way that it can be pierced. In general, the directors and officers are not liable for a mistake of judgment that harms the corporation if they were acting in good faith and in the reasonable belief their decision was in the best interest of the corporation. So they are also protected from the shareholders that might just want to sue them because the company is losing money. A merger is when two companies combine. And when they do that, there's only one corporation that exists. As I say, one corporation sort of absorbs the other corporation. Consolidation is a legal contract combining two or more corporations, resulting in an entirely new corporation. Now, in a merger, one company still exists at the end of it. In a consolidation, a new company exists at the end of it. Types of takeovers. A hostile takeover is one in which the management of the target corporate company tries to take them over, wants to merge with them, and the management doesn't want that because they're probably going to lose their jobs. So they object. They don't want this to happen. In that case, the aggressor, the acquiring corporation, offers the shareholders a price above the current market value of their stock. So they're trying to buy enough shares that they can control the votes. In which case, they would then vote as shareholders to take over the corporation or merge with the other one. An exchange tender offer is when the aggressor offers to exchange target shareholders' current stock for stocks in the aggressor's corporation. And cash tender offer, so they're offering cash money. So tender offers follow into two categories: exchange or cash. Now, you see on TV shows like Succession and all about, they're afraid of a hostile takeover. Well, the hostile takeover won't leave them penniless. It will mean that they will lose their jobs. If they own shares in the company, the shareholders are usually fine. It's the management that gets the boot. A leveraged buyout occurs when a group within a corporation, usually management, buys all the outstanding corporate stocks held by the public. Then that group gains control over corporate operations by going private and becomes a privately held corporation. And sometimes corporations will do that. They went public, decided it was a bad idea. Now they're trying to buy back the stock. How does a corporation die? Dissolution, file paperwork for that. Liquidation, process by which the trustee converts the corporation's assets into cash and distributes them among corporation's creditors and shareholders. Usually, unfortunately, by the time they do all the creditors, the shareholders don't get much. Voluntary versus involuntary. Well, voluntary dissolution occurs when the directors of shareholders initiate the dissolution process. An involuntary dissolution is when the state forces the corporation to close. Okay, so that's good. Read the chapter carefully, do the SMART book, and then good luck with the quiz.